In this presentation, we will take a look at bad debt expense as it relates to a sole proprietorship reporting on a Schedule C. We're focusing up top in the income section of our income tax equation, knowing that the income section will be supported by another schedule, that being the Schedule C, which will include both income and expenses, or income and deductions, including the bad debt expense, the bad debt deduction, but the net income then would flow forward to the 1040, which would be in the income section on it, which would look like this on line 7A. This is the 1040. We're concentrating on line 7A. It's supported by the Schedule 1. The Schedule 1 line 3 supported by the actual Schedule C. Bad debt expense. If someone owes you money and you cannot collect, you have a bad debt. There are two kinds of bad debts: business bad debt and non-business bad debt. A business bad debt is generally one that comes from operating your trade or business. You may be able to deduct business bad debts as an expense on your business tax return. So in other words, if you have a debt, in other words, someone owes you money. So when we're talking about the debt in terms of a bad debt, that means someone owes us money. They owe us a debt, because typically there would be a transaction that would have resulted in them owing us money in the past. Now, if we have a personal bad debt, then it's something that typically is not going to be deducted. We're not thinking about a deduction here on the Schedule C because we're talking about business income and business expenses. So if it's a personal bad debt, it's less likely we're going to get a deduction. We're not getting a deduction on the Schedule C for a business deduction. You can also think of a personal bad debt as something that may not have resulted in some kind of business exchange in the past. There might have just been a personal loan that now is not going to be repaid, and it's a personal bad debt. On the business bad debt, however, we would expect that there was some type of financial transaction that happened in the past, possibly goods or service, in exchange for a debt, accounts receivable, someone owing us money, and then at some point in the future that we've determined that that debt is not going to be collectible, we're not going to get that debt. That then would be a business bad debt, and you would think that we would get a deduction for that. Why? Because it's quite possible that in the past we had recorded income for it. It's quite possible that we said, hey, we did services in the past. If it's an accrual method that we're using, we recorded income at the point in time the work was done, the inventory was sent, or the services were completed, and therefore had to pay taxes on it at that point in time because we had the income on it. And now we're not collecting, we're not getting the money from it. And therefore, you would expect then that we would get to expense it at this point in time. We're not going to go back, in other words, and adjust the income that we over-reported possibly in the prior year, but instead record the expense this year. Now, you might be saying, hey, I see kind of a problem there in that, what if I'm using a cash method versus an accrual method? And you can see how you can have a difference there. If you're on a cash method, then you may not have recorded the expense in the prior year because you had not yet received the cash. Let's continue. Business bad debt. A business bad debt is a loss from the worthlessness of a debt that was either of the following: created or acquired in your business, or closely related to your business when it became partly or totally worthless. A debt is closely related to your business if your primary motive for incurring the debt is a business reason. Business bad debts are mainly the result of credit sales to customers. So we had a sale. That's typically what you would think of for a bad debt, right? You had a sale to a customer. You didn't collect the money for it. It was, in essence, a credit sale, an IOU. They're going to pay you in the future, and then they never paid, and it became a bad debt. They also can be the result of loans to suppliers, clients, employees, or distributors. Goods and services customers have not paid for are shown in your books as either accounts receivable or notes receivable. If you are unable to collect any part of these accounts or notes receivable, the uncollectible part is a business bad debt. Accrual method. If you use an accrual method of accounting, you normally report income as you earn it. You can take a bad debt deduction for an uncollectible receivable if you have included the uncollectible amount in income. So in other words, typically if you're on an accrual method, note that what would have happened, this is like the normal accounting method as opposed to a cash method. When you make a sale, if you made the sale and you didn't collect cash at that point in time, you would increase typically accounts receivable, possibly notes receivable, an asset account, and then you would credit or increase income. And if you increase income, it would be taxable income typically, and you'd pay taxes on it. And then later, if they didn't pay you, then it would be reasonable then to take a deduction related to that amount because you paid taxes on, you increased the income last time, now you should get a deduction because it wasn't really a sale that happened. Now, what if you're on a cash basis method? Notice if you're using a true cash basis method, you wouldn't have an accounts receivable account because that's an accrual account. You wouldn't really record anything until you get the money. So in that case, you wouldn't really have, a bad debt as you would normally think of a bad debt because you would never have recorded the receivable. The receivable couldn't have not become due because you wouldn't have recorded the receivable because that's an accrual account, and you wouldn't be recording anything until you actually receive the cash and would be recording the cash at that point in time. And if you never recorded the income, even though because you're on a cash basis, even though you did the work, then it would make sense that you shouldn't really get a deduction related to it because you're not really canceling out a sale that happened in the past. So a cash method, if you use the cash method of accounting, you normally report income when you receive payment. You cannot take a bad debt deduction for amounts owed to you that you have not received and cannot collect if you never included those amounts in income. So basically, if you obviously on a cash method, you would never have included it in income in the first place. Therefore, you don't have a bad debt expense related to it because you never recorded the income in the first place.